Here's the closing bell for today, Monday, November 21st.
And there you have it, your closing bell to kick off a new week. Let's take a look at how the market settled at the end of the day. We see that despite being relatively flat all day long, the Dow couldn't creep into positive territory. All three major indices ending in the red. The Dow there losing about 44 points. The S&P 500 down about almost 0.5% there. The tech-heavy NASDAQ down more than 1%. And we know those losses for the Dow would have been worse if not for that bump from Disney. Well, let's take a closer look at the broader markets with our markets panel. Let's bring in Aoifinn Devitt, Moneta Chief Investment Officer, and Eddie Ghabour, KeyAdvisors Group Owner and author of Common Sense Bull. Good to have you both here. Eddie, I want to first start with you in terms of what the markets are pricing in as we settle into these last few weeks of 2022.
So look, I think this bear market bounce that we've seen, which isn't the first one we've had this year, of course, is pricing in a Fed pivot, and as well as pricing in that inflation is going to continue to cool off at the same pace it did last month. And this is where we think the market has not properly priced in what the inflation data is going to look like for the month of November. So we are encouraging our clients to raise cash into this rally. We just raised cash again on Friday because we think when this inflation data starts to come in December, it's going to prove two things. Number one, the Fed is not going to pivot. And number two, it's going to show that inflation is going to be very, very sticky, and we're not going to see as big of a drop in the headline inflation numbers as we did last month. So, and lastly, I'll say, look, crypto is one of the most highest risk assets out there, and that's what led us down. If you look at a year ago today, and I think it's sending some signals, especially to the NASDAQ. We think that there could potentially be another 15 to 20% downward in the market over the next 4 months.
All right, Aoifinn, want to get your reaction to all that. The NASDAQ got another 15, 20% left to fall, that the Fed will not pivot and inflation will prove stickier than once thought. Your thoughts?
Well, I agree with a lot of that, but also disagree with the fundamental premise that we are looking at inflation now being stickier. I actually was very much expecting that turnaround we saw in the last month. Some of the key components like energy as well as commodities, all food, they are coming down. And the Fed is very focused on the transmission rate of its policy. So the rate at which the interest rate rises are actually having an effect. It's having a patching effect across different parts of the economy. We've seen it in house prices. We saw it in used car prices again. They've fallen dramatically. We had the section about Carvana just earlier. So I do think that we're going to see a little bit of softness. In terms of consumer demand, also indications are the consumer isn't quite as frothy or spending quite so much as they were perhaps at other holiday seasons. So I think that's going to also trickle through. So I do think that the Fed will not pivot though. And there's a difference between pivoting and decelerating. Even decelerating might be interpreted as a pivot, and that may mean that markets do get a little carried away as they did perhaps earlier. But I see actually more strength going into the end of the year because a lot of this negative news has already been discounted in. And I agree with the guest about the contagion effect for Bitcoin and other digital assets. That's definitely going to take its toll on tech. But tech is not where we're focused right now. We're focused more on the defensive areas such as energy, healthcare, and some of the consumer staples.
Eddie, let's talk about why you think inflation is going to be so much stickier than many in the market seem to think at this point. What are you noticing that so many people are missing?
So I think when you look at rents, right, I think rents are going to continue to stay high for the next 12 months. And I think, look, to the other guest's point, there are certainly signs. I believe I'm in the camp that inflation has peaked. But again, when you look at food costs and the day-to-day living expenses that the consumer is being faced with, I just don't see how we get anywhere near where the Fed's trying to get to 2 or 3%. The only way you're going to get there, in our opinion, is to have a deeper recession then that's priced in. And I think that's exactly where we're going. And look, the bond market, in my opinion, is smarter than the stock market. We've had one of the largest inversions of the 2s and 10s and we've had in recent history. So the bond market is telling us to be prepared for a tough winter in this market and this economy. And I think you're going to see that happen with revisions that you're going to get in regards to earnings looking out over the next 12 months. So we do have some healthcare exposure and consumer staple exposure, but we have a huge cash position. we plan to be buyers of this dip. Make no mistake about it. I think we will not have a Santa Claus rally in December. We'll probably be buyers towards the end of December, going into January, February, and March. And I think the second half sets up really nice for next year. But this market is not pricing in a recession.
And Aoifinn, do you see any opportunities to jump in now, or are you waiting?
I would agree with Eddie in that we definitely cash is no longer trash. Cash is a good place to park cash right now. There are really meaningful returns on that, and equally fixed income is looking increasingly more relevant and just meaningful in terms of its actual nominal yields. So I'd agree with that. But I actually do think that we are pricing in. We've seen this telegraphing coming from companies for some time, telegraphing a slowdown in earnings, telegraphing rising inventories. Then they were able to turn around and actually say, well, things perhaps aren't as bad, or we've managed to clear that, or our supply chain restraints have been lifted. So I think there's a very careful massaging of expectation going on. We see that at the Fed. We see that at a company level. So for that reason, I'd be surprised if we saw earnings really surprise on the downside, because it's just being manipulated so easily. So I do think that markets are stable, and we can see that coming in after the midterms. We saw a real acceptance, initially a little bit of surprise perhaps at the result, but a real acceptance that now we have some visibility to the next 2 years, potential for legislative change to happen. And I think that all points very stable. And let's not forget about the employment rate. Despite some very high profile drops in tech company employee numbers, the employment rate is still historically extremely strong. And as long as the consumer is bolstered that way, I believe sentiment will follow.
And it's the consumer. You just mentioned it, and Eddie, that's the reason for really your whole setup. What are you seeing specifically from the consumer that tells you it's the worst macro setup since the Great Recession?
Look at the amount of debt that the consumer has right now. We're at multi-year highs in regards to debt. A lot of this consumer spending data showing them being resilient is being put on credit cards. The other thing you're starting to see the rate of change on 30-day late payments on credit cards start to increase. This is what happens at the beginning phase. So we are just getting started in this. The consumer has definitely been extremely resilient, but I think they're running out of steam. And that's, in my opinion, going to be proven here in the coming months. And look, on top of all that, let's look at housing, okay? We now have mortgage rates that are double what they were a year ago. And so that's just now starting to show signs of cracking. And I don't think there's anything that has a bigger impact on the global economy as housing does. And if housing prices go down by 15 to 20% next year, which I think is realistic considering the cost of capital is more than double, that's going to be very catastrophic to the economy. And lastly, the fact that the labor market is tight is another reason why the Fed is going to continue to tighten. Unfortunately, I think they're looking at rear view mirror data, but the reality is this labor market will continue to stay tight because that's the last shoe to always drop in a recession. So they'll probably raise in December. They'll raise at the beginning of next year. And by the time they pause, it's going to be because we're in a deep recession.
Excellent back and forth there. Eddie Ghabour, Aoifinn, Devitt, really appreciate that. Good stuff.